So right now the topic going on is Fed policy tools. Under that we have seen open market operation, the discount window. Under discount window there are three programs: primary, secondary and seasonal credit program. Now the third is reserve requirement. Reserve requirement is again similar to CRR and SLR. Reserve requirements are the amount of funds that a depository institution must hold in reserve against specified deposit liabilities. Within the limits specified by the law, the Board of Governors has sole authority over changes in the reserve requirement. So this Fed Board of Governors can change the reserve requirement, just like RBI can change the reserve requirement. Depository institution must hold reserve in the form of vault cash or deposit with Federal Reserve banks. So where will that reserve be maintained? With the Federal Reserve banks. So which is like CRR, you can say. Fourth Fed tool is interest on required reserve balance and excess balance. Does Fed pays interest? Federal Reserve Bank pays interest on required reserve balance and on excess reserve balance. Very good. Does RBI pay interest on CRR? No. The interest rate on required reserve is determined by the Board of Governors of Federal Reserve. So Federal Reserve is good or RBI is good? Both are good. Federal Reserve pays interest. Next is paragraph 5, overnight reverse repurchase agreement facility. Overnight reverse repurchase agreement facility. This is like reverse repo. This is like reverse repo. When the Federal Reserve conducts an overnight RRP, reverse repurchase agreement, it sells a security to the eligible counterparty and simultaneously agrees to buy the security back the next day. So this is similar to write on reverse repo. Now an important question for the student of CA course, final course. How does Fed fund rates impacts the global financial market? Does it impact? First I'll explain, then we will read, because once I explain, then reading is simple. Suppose US Federal Reserve increases the interest rate. What will happen? Many foreign institutional investor, pension fund and such other large institutions who invest outside India, outside USA, then they will try to invest in US government security only, because interest rates have increased. So they will pull the money out of other countries and invest in US government treasury bills or government securities. But this will cause a damage to the stock market of that other country, because if FIIs pull out in large number, share prices may crash. It may affect the wealth of the shareholders of that country. Okay, so that is the impact of Federal Reserve. Vice versa also, if they reduce the rate, then money may flow out of USA to other countries, and then the other countries will find more and more money coming into their country. Their stock prices may rise. Even by 0.25% or 0.5%, if they change the rate, it has a huge impact in the US economy as well as the global economy. So the question that they can ask you is this: what is the implication of Fed fund rates? I've written the question on the global financial market. This is a good question to be asked from the students. The Fed fund rates is the interest rate at which the top US banks borrow overnight money from the common reserve. So rate at which banks borrow from Federal Reserve. The Federal Fed fund rate gives the direction in which US interest rate should be heading at any given point of time. So it's an indication whether rates are going up or rates are coming down. If the Fed is increasing the interest rate, what is the signal to the market? That interest rates are going to go up. Lending rates for the companies and retail borrowers will go up. Vice versa means if the Fed is decreasing the interest rate applicable to companies and borrowers will also fall. In India, hike in repo rate may not impact the countries outside India. Not much. If RBI increases or decreases the repo rate, it won't affect USA much, Pakistan much, England much. But if US Federal Reserve increases or decreases the rate, it may affect the Indian financial markets. Does change in US interest rates matter? Does change in Federal Reserve rate matters? So the answer for that is point number E. You can add this question there in point number E, F, G, H, I, J. Does change in US interest rates matter? Does change in US interest rates matter? So what answer will you write? US interest rates matter a lot to global capital flows. And then as I have explained it to you, that some of the world's richest institutions and investors have their base in USA. All these big funds that invest in India are based in USA. They are only interested in maximization of return. They may not have love and affection with any country. Yes or no? So what they will do, they will continuously compare Fed rate with interest rate across the world and then make the allocation decision. So any change in the Fed rate means their decision will change. Either they will invest more in USA or they will move out of USA. So any change in Fed rates impact the domestic borrowing market to a large extent. For instance, if the Fed rate goes up, it will make the RBI hesitant in cutting rates at that time. True or false? Because if USA is increasing the rate and RBI is decreasing the rate, where will US investor invest? In USA. So RBI also have to keep the rate on a higher side. Otherwise the US investor will move out of India, whatever money they have invested, and take it back to their own country. Okay. So therefore it says that change in Fed rates impact the domestic borrowing market also to a large extent. The reason is that if RBI cut rates, it will lead to heavy pull out of foreign investor from the Indian bond market. Further, just US interest rate matters to stock market also. Is there any link between US interest rate and Indian stock market? There is a link, because the investor will pull out of Indian stock market and invest in the US bond market. So foreign investor invest heavily in the stock market. The reason is zero or near zero return on the safe investment in the US. Interest rate is very low. But if the Fed rate goes up, it may lead to mass exodus of foreign investor from the Indian stock market. Can you understand the implication? They will sell the shares in India, take the money to USA, invest in US government bonds and treasury bills. But does it affect Indian stock market? Yes. Too much of selling of shares will reduce the share prices in India. Indian stock market can crash. Indian investor can lose their hard-earned money. Is it right? So now Indian stock market to a large extent is influenced by the actions of FIIs. So this is the meaning of this paragraph. What is the implication of Fed rate on the global financial market? Now in your syllabus, they have given you 3 indices also for understanding the effect of changes in price level. For understanding the effect of change in price level, three indices you have to learn. One is what is appearing on the screen right now, cost inflation index, then consumer price index, and wholesale price index. Good news, this you have learned in income tax. Yes or no? What does Income Tax Act says? That in case of long-term capital gain, if you have purchased a long-term capital asset, then you don't have to compute the capital gain on the difference between selling price and cost price. Rather, you will calculate the indexed cost and compare with the selling price. Index cost means what would have been the cost of this asset today considering the changes in the price level. Artificially, they are increasing the cost of that asset so that the capital gain burden is reduced. Otherwise, capital gain will be a huge amount. Land was purchased 15 years ago at 2 lakh, may now sell at 35 lakh. So you'll have to pay a huge amount in taxation. So what they will do, artificially they'll increase the value of that land. Is it right? So that is cost inflation index. I don't have to teach this. Already you have learned. CII is an index which is used to measure inflation, which is used in the computation of long-term capital gain with regard to sale of an asset. I'm going little fast because you know it. CII for a particular year is fixed by the government. So central government announces that inflation index released before the accounting year ends for the purpose of tax computation. It is useful in calculation of the indexed value of the capital asset. We'll take one example also little later. It helps a taxpayer in computing the actual long-term capital gain or loss on selling of capital asset, and also allows the taxpayer to factor the effect of inflation on the cost of their asset. One important point which you should not write in the exam: who earns capital gain, poor or rich? Generally rich. Who gives donation to the political party, poor or rich? Who should be helped by the political party? Rich. So therefore such kind of schemes are designed so that the rich will have to pay lower tax. One benefit, indexation. Second benefit, rate of tax is also lower for long-term capital gains. Is it right? So don't write that in the exam, but that was the pressure of rich people on the government to bring such kind of provisions in the income tax law. And politicians also have more money. Recently I heard in the newspaper one Telangana minister has 5,000. He's a union minister. 5,000 crore rupees amount he has done the fraud. This is the newspaper. I don't know true or false. My God. To calculate the indexed cost, what we'll do, I will not read that paragraph. Take the cost of that asset, multiply by index of current year, divide by index of the year of purchase, divide by index of year of purchase. So that will give you indexed cost that you deduct from the sale value. If the difference is positive, you will pay tax on that amount. Okay. Since the government levies a tax on such transaction, the owner would be required to pay a large amount of tax. In order to avoid paying a large sum towards tax, the purchase price of the asset can be indexed to show the asset value as per its current value, taking into account the inflation. In this manner, profit derived from the sale would be lower, thus reducing the capital gain available. The indexation helps the actual value of the asset to reflect at its present market rate. The logic given by them is that we should compare the current value of the asset with the sale value, taking into account the reduction in its value due to inflation. While selling the asset, the purchase price is referred to as indexed cost of acquisition. One example is printed below on the screen. You can just follow me. Suppose you purchase a house for 25 lakh in January 2005 and sold it for 70 lakh in January 2015. So mathematically you have made a profit of 45 lakh. If you pay tax on 45 lakh, it will be a big amount. So what they have done, they have said, no, wait, we will allow you to compute indexed cost. So they have given in the notes, which may or may not be right, we are not bothered. The year in which the apartment was bought was 406. The year in which the apartment is sold, the index is 1081. This is given by the government. Right now, I am not interested in identifying how do they calculate this index. Do you know? Some weighted averaging they do. Huh? How is actual calculation done? I don't know. But it's based on some weighted average calculations. So now what you do? Current year index is 1081. Year of purchase index is 406. So the ratio is 2.66. Multiply this ratio with the cost of acquisition. So the index cost of acquisition will be now artificially increased from 25 lakh to 66 lakh 50,000. What an idea. And now therefore your actual capital gain will be just 3 lakh 50,000. And assuming your tax rate is how much? 20%, you will only pay 70,000 rupees tax. Had you not done this indexation, you would have paid 4,50,000 rupees tax at a normal rate, 10%. And therefore, when index benefit is taken, it helps you in saving the taxes, etc. To my understanding, this page is a waste of time of a CF final student. Okay. No, we just took 5 minutes for that page. It's a part of syllabus, so I had to take it. It's there in your study module. Now the next two things which you are already aware again, but will go into little more detail than your existing knowledge. Consumer price index and wholesale price index. Why these are calculated? To measure the inflation. The purpose is to check what is the inflation in general in the economy, and accordingly the government policies are decided, monetary policies are decided. Okay, so many decisions of the government or monetary authorities are based on what is the inflation in the economy. And two types of inflation are calculated in India. One is for consumers. So this is called retail inflation. For consumers like us. And then for producers, we calculate what is called wholesale price index or wholesale inflation. So CPI, WPI. CPI is for retail inflation. It is for wholesale. CPI is for consumers. And as you can understand, this is for wholesalers. Wholesalers. CPI considers goods and service in calculating the inflation. WPI only considers goods. WPI calculation only considers goods. That is a criticism of WPI. But right now this is how the government does the calculation. These are some basic thing about CPI and WPI. Okay. Even the items used in calculation are different. For CPI they will include food items more, because consumers spend more money on food items like bread, wheat, milk, fruits, vegetable. Okay. And they also consider services in CPI like health, education, insurance, okay, etc. But services are completely not considered in WIP calculations. So let us go through it quickly. Again, a topic from economics only. A CPI is designed to measure the changes over time in general level of retail prices. Underline retail prices. CPI deals with retail prices. Suppose you buy one pouch of milk, that is retail price. Of selected goods and services that household purchase for the purpose of consumption. So what they do basically, understand mathematically. Suppose last year in this list, what they will do, they'll make a list of biscuit, milk, okay, besan, tomato, poha. I don't think so. Something like this. Okay. Last year, what was the price? They will take the total. Suppose it comes to, for example, 1000. This year, what is the price? And they calculate what has been the change. Let us say this is 180. So we'll say 8% is inflation compared to the previous year. In general, the prices of goods and services which Indian consumers consume has increased in general by 8%. In general, because it is an average. It is possible milk may have increased more than biscuit. Okay. Any index gives you an average idea about the movement of prices. Like BSC Sensex tells you that during a given period, share market on an average has increased by 12%, but every share has not increased by 12%. Some may have increased by more than that, or some may have decreased by some percentage also. But at least it gives you some idea as to, in general, how the retail prices have behaved during a period. It's very simple calculation. What was the price in the earlier period? What is the price in this period? Calculate the change in percentage, that is inflation. Many people use the word inflation, but actually they don't know how it is calculated. So today you are learning how inflation is calculated. Inflation affects the purchasing power of consumers' income and their welfare. Higher the inflation means purchasing power of their money has gone down. Earlier they used to spend 1000 rupees to buy this basket of goods and service. Now is spending 1080 rupees to buy the same basket of goods and service. That means he has to spend 80 rupees more to get the same basket of goods and service. So purchasing power of his money has gone down. CPI measures price changes by comparing through time the cost of a fixed basket of commodities. You write commodities and services. Commodities and services. For CPI, services are also considered, like education, health. This basket is on the expenditure of a target population. Basket is based on the expenditure of a target population in a certain reference period. That is how much consumers spend on different items. Since the basket contains commodities of unchanging or equivalent quantity and quality, the index reflects only pure prices. This index is based only on pure prices. Total price of a basket of goods and service they will take compared with the same basket of goods and service in the next period. Traditionally, CPI numbers were originally introduced to provide a measure of changes in the living cost of workers so that their wages could be compensated to the changing level of prices. What was the original purpose of computing CPI in many countries? To compensate the workers. If the inflation is 8%, workers' salary will also increase by say 8%, so that they are protected from the rise in prices. But now CPI is used for policy making also, not just for wages. The dearness allowance calculation is nothing but it is based on the inflation index only. But now CPI is not just a tool for measuring the wages, it is also used for many macroeconomic policies. It is used by the government, etc., for maintaining price stability, for targeting the inflation. You have seen in this chapter, if RBI thinks inflation is too high, they will change their monetary policy accordingly. CPI is also used as a deflator in national account. What is deflator in national account? They have not explained. But suppose GDP, say for example, GDP in 2010 is for example 1000 rupees. Okay. And GDP in 2011 is suppose 1090. So if I do not adjust for the change in prices, we will think that GDP has increased by 9%, but actually it is not. Some increase in this may be due to just price level, which is not the real efficiency. Which is not the real efficiency. Real efficiency lies when your output increases. So what they will do? They will artificially say increase it to multiply by 105 divided by say 100. 5% inflation effect they will give. What would have been the value of this today? 1050. Or what they do practically, they convert into a constant price, reverse working. Had there been no inflation, what would have been the GDP? Had there been no inflation, what would have been the GDP? So they'll multiply by the index of the base year with which you are comparing, multiply by the current year index. This will call deflation in the GDP figure, because your actual GDP in current purchasing power, current rupee value is 1090, but constant rupee power, had there been no inflation, will be much lower. And then you say the GDP has increased by so much percentage. So this percentage you will find is much lower than 9%. Is it right? This is the meaning of deflator in the national account. That means GDP is compared after adjusting the effect of inflation. Otherwise, it may give a wrong picture. Maybe the output has reduced, but price level has increased more, and GDP may seem to be increasing. Continue. Given the many uses of CPI, it is unlikely that one index can perform equally satisfactory in all applications. One more thing you should know, there are more than one CPIs. There are CPIs for urban consumer, CPI for industrial workers. Okay, but now the government has reduced the variety. Earlier it was different. CPI for urban consumer, CPI for agriculturist, farmers, CPI for industrial workers. Because different people are in different situation. Their basket of goods and services can be different. A rural consumer may not purchase biscuit, may not purchase Maggie. Example. So therefore you can't use a common index for an urban consumer also and for a rural consumer also. So there were different CPS, but now they have reduced the varieties. Therefore, there is a practice of compiling several CPA variants for specific purpose. Each index should be properly defined. That means you have to write very clearly that this CPI, they used to write like this: CPI IL for industrial laborers, CPI for urban consumers, so that we'll understand this CPI is for this particular category of consumers, and accordingly the policies will be decided. To avoid confusion, it should be properly defined. Then now next is, what are the items to be included? That is a very debatable issue. How much item will you include? Is it right? Nowadays there is a debate that we should also include mobile phone also, then internet usage also. Yes or no? Any other suggestion? So therefore they have to divide the different items into several categories first, and within category there will be subcategories. Just for example, the categories can be food, categories can be fuel, categories can be manufactured items, and then under that now they will decide which food item we should include. For example, you can include, let us say, fruit, vegetable, milk, pulses. Yes, in fuel they will take gas, kerosene, petrol. This is the example to understand the next few paragraphs. Okay, actual list is different. Interested student can do the research on Google and you will find which items are actually included in the consumer price index calculations. So like this, manufactured item can be again biscuit or bread, butter, anything which consumers use. They have made a list. Services. A classification is a procedure in which items are organized into categories. These are categories: food, fuel, manufactured item, services, based on the information on one or more characteristics inherent to the items. Classification is the first step in compiling the CPI. Government has to spend a lot of time in deciding what will be the classification and what will be the items under that classification. In the years past, countries use their own distinct system for classifying the range of products covered by their CPI. Each country have its own range of items included in their respective CPI. But now what is happening, now this is important, you can underline. If you use your own classification, it will not match international comparison. Yes or no? You can't say inflation in India is 7%, inflation in China is 8%, so China is more than India. The reason being, they may use altogether different items in their classification or calculations. So therefore, now this point says many countries have now, however, moved to international standard classification, which is called COI-COP. What is COI-COP? Classification of individual consumption according to purpose. Is it written in your book? Classification of individual consumption according to purpose. So this will make international comparisons easier. In order to ensure better comparability with CPI of other countries, it is desirable to have the classification of items synchronized with COI, COP. World over now standardization is taking place. Do you know that? In every field, the size of a mobile or the type of mobile charger is same across the globe now. Maybe only Apple has a different charger. You can use one charger and use in other mobile. Why? Standardization. Same thing for classification of items also, so that you can say yes, in India inflation is more than China or lower than China, because then the classification is standardized. But at the same time, we have to keep local needs in mind for local policy making. It is also important to make it relevant to the Indian context by making it comparable to groups and subgroups being followed in the CPI series compiled in the country. So this will be always a challenge before the government, what items to be included, whether they should give more importance to local need or international criteria. Okay, so accordingly all consumption items have been classified under various group, categories, subgroups and sections. But in your module they have not given any example on this. Now next is issues relating to consumer price index. Paragraph 4.2. What are the challenges, drawbacks, criticisms, limitations of this CPI calculation? Do you find any challenges here? The first point is that 90 to 95% of the index is not affected by the interest rate, as the amount spent on household is not affected by the rate changes. So interest rate have not been given any importance in the calculation. This include food products. Now if I have to eat something, will I look at the interest rate? Usually no. Housing, fuel expenses, these are fixed cost and have to be spent irrespective of the rate of inflation. Second is CPI does not make sense to the household. Today you go to your home, and tell your mother, this year inflation is only 6% as per Government of India statistics. She says, are you mad? Today I purchased this milk pouch, it has increased by 20%. I filled my petrol in my bike and the price have increased by 25%, and you are saying inflation is 6%. So government gives you average change in price, but individuals look at it, how much I am affected. Potato, tomato prices may shoot up by 100% and you are saying 6% inflation. Is it right? So that is the problem. Individuals are not able to understand how it is 6%. When I can see around me everything has increased by 10, 15, 20, 100% also. A 2% CPI does not seem convincing to a housewife who believes that price of most of the commodities are on the higher side than that reflected by the CPI. Yes or no? So it is frustrating for the consumer who after every fall in the rate of inflation finds that the actual price is on a higher side. You also think about it. Recently government says our inflation is 2%. But when you look around you, everything has increased. Yes or no? Last year how much you paid for petrol? 65 rupees. Around 65. Now you are paying how much? Around 75? 80? Is it 2% increase? It is much more than 2. So then you are saying, what is the use of CPI to me? I don't trust it. For example, price of tomato may suddenly increase from 30 rupees to 80 rupees per kg. Does it happen? Yes. Similarly, the price of tur dal. What is tur dal? Pulses, yellow color. Also called rahar dal, arhar dal in different states, okay? Which is what you eat in your dal. Sometime it increases from 40 rupees per kg to 200 rupees per kg in a short span of time. And then the government is saying inflation is 2%. As a housewife, you'll get angry. Yes or no? As a customer, you'll get angry. You will not vote to such government. You'll say, you are saying 2%, but my family budget has got completely disturbed. So, however, prices come down slowly and now it is 80 rupees per kg. It was 40, it went up to 200, it is 80. Government will say inflation has decreased from 200 to 80. See how much price reduction have taken place. But you will say actually it was 40 and now it is 80. So still it is 100% increase. But government will say no, last year it was 200, now it is 80. So there is a negative inflation in our country. Consumer should be happy. Okay, next is third limitation. General view is that HRA allowance paid to central government employee would tend to raise the inflation. In India, we give lot of allowances to employee to compensate them for inflation. But actually, allowance will further increase the inflation as it will increase the cost of production for the company. If you give more wages, whatever name you gave it, it will increase to the cost of production, and cost of production will further increase the inflation. However, if the government employee is residing in a government accommodation, HR is automatically deducted from the pay slip of the employee. On the other hand, if the employee is not staying in the government accommodation, the amount in the pay slip goes up. This will increase. This increase in HRA will translate into higher cost of living or higher retail demand. Anyway. India is a very big country. Okay, India is a very big country. It is very difficult to arrive at any general figure. But then again, we can't, as a central government, we can't decide on state-wise basis or local basis. I don't think so. They do the reverse working. At least officially they will not say, and I will also not say officially. Is it right? But like you, I also believe, which is an unofficial statement in the class, that they do manipulate these inflation figures. Okay. Because it is a serious election issue. Governments can change because of inflation, especially countries like India where every rupee matters to a individual. Okay. So therefore, I don't know how do they calculate, but some degree of changing here and there may be possible. They may change the weight of that item whose prices change more. They will reduce its weight in the index. But yes, this is something interesting. How do they calculate it? I will try to do more research on that. Right now, not relevant to your syllabus. Only this much is enough. If any question on CPI and WIP is asked, you come to this 2 pages, write the answer accordingly. Basic concept I have told you, it is retail inflation, this is wholesale inflation, it covers goods and service, it covers only goods. Okay. WIP measure the average change, underline average word, in the price of commodities for bulk sale underline at the level of early stage of transaction. For WIP calculation, what they have done, they have divided the commodities into three groups: primary article, fuel and power, manufactured products. This can be an MCQ question. Following items are covered in WIP calculation. So you have to remember primary, fuel and power, manufactured, and they will give you services also. Which of them is not covered under wholesale price index calculation? So services are not covered. The index basket of present 2011-12 series. Now what is the base year of this index now? 2011-12 has a total of 697 items. How many items they have together? 697. Out of that, 117 are primary article, 16 are for fuel and power, and 564 for manufacturing products. So the question will be, which of the three types is given more weightage in the index? So you will say manufactured products are given more weightage in WIP index. Okay, manufactured products are given more weightage in the WIP index, and it is given less weightage in the retail index. Not mentioned, but remember that manufactured items are given less weightage in retail index. In retail index, food items are given more weightage. Price tracked R. Now, how do you calculate the price? In case of manufactured item, they take X factory price, underline, because these are the question you have to answer. What is the basis for calculating manufactured product price? X factory. Once the goods leave the factory, that price they will take. In case of agricultural commodity means primary. Come to this point, primary bracket, right? Agricultural commodity. For agricultural commodity, they take prices from the mandi. What is mandi? Market. A market where all the agriculturists bring their product and they sell in that wholesale market. That wholesale market is called mandi. And for mineral item, they take X mines price. For mineral item, they take X mine price. So basis is also different for different categories. Weights given to each commodity covered in WIP basket is based on the value of production adjusted for net imports. So weight will be given according to value of production. So of course the value of production will be more in manufactured items, because there are many commodities in the manufactured items. So manufactured items get more weightage adjusted for net import. WIP basket, underline for a question in the exam, does not cover services. In India, WIP is also known as headline inflation rate, underline headline inflation rate. Most of the inflation rate which you read in the newspaper is WIP. That is called headline inflation rate. It makes newspaper headlines. The base year of all India WIP has been revised from 4-5 to 11-12. This is also important. Now the base year is 11-12 for WIP calculation, and I think it is 2012 for CPI, but we have to check. Okay, just write one homework, check base year for CPI, check base year for CPI, which I think recently they had revised to 2012. And one more point is, in case of CPI they use calendar year, in case of WIP they use financial year. For CPI they use calendar year, means in CPI you will see it is written year 2012 is the base year, whereas for WPI you will find it is written 11-12 is the base year. CPI uses calendar year, WIP uses financial year. Your homework is you have to check what is the current base year for CPI. Whatever minimum knowledge I have, I think it is 2012, but still we'll confirm it. Is it printed in the notes on CPI? It was not mentioned anywhere. And who does this calculation of WPI? WPI calculation is done by the Office of Economic Advisor, Department of Industrial Policy and Promotion, Ministry of Commerce and Industry. So it comes under Ministry of Commerce and Industry. Under that there is a Department of Industrial Policy and Promotion. So they do this calculation. But such question they don't ask in the CA exams. They ask in IPS, IES exam, MPSC exam. Okay. You have to remember who does all this calculation. Again, repetition. The Office of Economic Advisor, Department of Industrial Policy and Promotion, Ministry of Commerce and Industry calculates the WIP. So they gather data from all the industries, all manufacturing unit, and then they do the calculation. The main use of WIP are the following. Why do we compute WIP? First is to check what is the inflation in the wholesale transaction in the economy. Okay. What is the benefit of knowing inflation? Policy making. Once the government knows that the inflation is high or low, they will accordingly take the necessary steps to decrease or increase the inflation. Too low inflation is also not good, because then businessmen get depressed. Businessmen should also make profit only if the price will rise. So negative inflation is also not good for the economy, because then producers go into depression mode. They are demoralized. Too much of inflation is also not good, because consumers will get affected. So they understand inflation, take policy decisions. WIP is used as a deflator for many sectors of the economy, including for estimating GDP by the Central Statistical Organization. This I have explained. So which is the deflator used for GDP? WIP. That means GDP at current price is converted into GDP at constant price. GDP at current price is converted into GDP at constant price by eliminating the effect of inflation. By eliminating the effect of inflation, so that the 2 years GDP can be compared. Otherwise, it is possible GDP may have increased not due to output but due to price level. So GDP inflators are used. Who calculate GDP in India? Again, a general knowledge question. CSO, Central Statistical Organization. WIP is also used for indexation by users in business contracts. Okay. So there can be escalation clauses in business contract. And this escalation clauses may say that it will be based on WIP announced by the government of India. Possible. Global investors also track WPI as one of the key macro indicators for their investment decisions. If a country has high inflation, its currency would depreciate. Purchasing power parity theorem in SFM. Yes or no? If a country's currency would depreciate, it will attract, or it will not attract more and more investor. Because when the investor will take their money out, they'll get lower amount of funds back. Because by that time the exchange rate would have changed. So therefore a high inflation may dissuade, means not appeal to the foreign investors also. Why recently many foreign investors have run out of the country? One of the reasons is because of high inflation also. Rupee is depreciating. Higher the inflation, higher will be depreciation in home currency. And if home currency depreciate, foreign investor will not be interested in investing in that country. Okay. Because when they invest, they get 1 lakh into 70. When they withdraw money, 70 lakh divided by 80 means they get lower amount in dollar terms. Now this you can understand such sentences only if you have studied SFM, purchasing power parity theorem. Next line, last paragraph for the topic. Already I have explained this paragraph once again. What is the difference between WIP and CPI? So WIP measures average price change for bulk sale of commodities at the first stage of transaction. That is when the goods reach the market for the first time. For manufactured item, X factory price. For agricultural item, mandi price. For mining items, X mine price. Okay. CPI reflects average change in price at retail level paid by the consumer. Suppose you can't remember so much or you don't have so much time. You don't have to remember actually. So you will say wholesale price index measures wholesale inflation. Consumer price index measures retail inflation. Because in the exam, suppose you don't have time, then you can write like that. Price used for compilation of WIP are collected at X factory level for manufactured product, at X mine level for mineral product, and mandi level for agricultural products. In contrast, retail price applicable to consumers are collected from various markets are used to compile CPI. It's collected from retail market, you can say. One student is saying that suppose in Tamil Nadu the price may be different, in Northeast the price may be different. But this is average. One of the problems of averages is this only. Okay. I asked my friend, what is the temperature in your city? He said average temperature is 11 degree. I said okay, 11 is good in this season, I can manage. When I went there it was -3. I said what kind of friend you are? You said 11 degrees is your average temperature, but when I came here it is -3. I don't have enough woolen garments to manage such cold. He says, I said average. Sometime it is -3, sometime it is 15, sometime it is 20. So I gave you average figure. I didn't give you what will be on a specific day. Okay. Average is sometimes misleading. Virat Kohli's average is 56 runs, but sometimes he gets out for 0 also. Many times you will observe, if you have that interest of reading newspaper, wholesale inflation and CPI inflation are very different. Because wholesale inflation they may say is 8%, but retail inflation they will say is 12%. You'll wonder how there is a 4% difference. It is because the goods and services are covered in CPI, only goods are covered in WPI. Weights are also different. Food items get more weightage in retail index calculation, and manufactured items get more weightage in wholesale price calculation. Because of that, what will happen? If retail items have increased more in terms of price, CPI will increase more because it has got more weightage, and WIP will increase less. So the reason for divergence between the two indices can be also partly attributable to the difference in the weight of the food groups in the two baskets. CPI food group has a weight of 39.1% as compared to the combined weight of 24.4% food articles and manufactured food articles in WPI basket. Why don't they consider services now? I will forward your suggestion to that Ministry of Industry and whatever was that, Commerce. See, these are all political issues. Sometimes, in spite of knowing that this should be considered, they don't. That might increase the inflation, because in India services are getting costlier. It is predominant. It is getting costlier. But teacher used to charge 4,000 rupees for FR, now is charging 24,000 rupees. Yes or no? So these are sometimes politically motivated calculations. So they also are smart. They don't include such items which has a higher inflation. Anyway, let us complete the next few paragraphs. The CPI basket consists of services like housing, education, medical, recreation, etc., which are not treated in WPI basket. A significant proportion of WPI item basket represent manufacturing inputs and intermediate goods like mineral, metals, machinery, etc., whose prices are affected by global factors. But these are not directly consumed by the households and are not part of CPI item baskets. So next point of difference, you can say that the items covered are very different under the two baskets. Point number 6 in your book. Thus, even significant movement in items included in WPI basket need not necessarily translate into movement in CPI in the short run. Suppose the price of metal goes up, steel goes up, it will affect WPI, but it may not immediately affect the CPI. It will take some time to get transferred to CPI. The rise or fall in prices at wholesale level spills over to retail after a time lag. Because first it will go to the market, then from market wholesale it goes to retail market. Some of them may not form part of retail price calculation also. What is included in WPI may not be included in the CPI. Similarly, the movement in prices of non-tradable items included in the CPI basket widens the gap between WPI and CPI movement. The relative price trends of tradable vis-a-vis non-tradable is an important explanatory factor for divergence in the two indices in the short run. Non-tradable items which you cannot transfer to other countries, which you cannot. Non-tradable does not mean you can't trade in it, but say for example, as you said, the haircut of a barber, can it be traded outside India? But that will affect your CPI calculation. So some items are such which you cannot trade in the international market, especially services. Especially services like haircut given by a barber, that services can be availed only at that particular place, not in the international level. So the movement in prices of non-tradable item included in CPI basket widens the gap between WPI and CPI movement. Okay, so this chapter is over. Now we'll continue tomorrow.